We are now on the brink of a black swan debt market collapse, as the US government may have to sell up to $1 trillion of new bonds in an emergency debt issuance. Now, this is because the Supreme Court has just announced that they are skeptical that Trump's tariffs are legal, with hearings beginning last week. Now, the chance of the court ruling in favour of Trump's tariffs on betting markets like Polymarket have plunged as low as 18%, and if they do indeed get ruled as unlawful, it would leave the US government on the hook for paying out refunds for importers across over 150 countries. Although the exact figure is yet to be determined, more than $100 billion would need to be paid out immediately just for refunds across a number of different tariff policies implemented since Trump came to power. However, this sum could swell to $1 trillion if the court takes until June to reach a final ruling decision. Now, Trump himself has described the ruling decision as being life or death for the US, and the bond market did react negatively, with the market selling off and yields rising across the board as anticipation for an influx of new US Treasuries flooding the market increases. But this really is just one extra nail in the coffin for the US debt situation, which is becoming more perilous by the week. US government debt has now surpassed $38 trillion, an increase of $10 trillion in less than 5 years, a rate of increase that is nearly 5 times faster than in the 2000s, with an extra $1 trillion getting added every 145 days on average so far in the 2020s. This insane debt increase is driving up the government's debt interest expenditure, which now exceeds $1.1 trillion every year, eating up an ever-increasing portion of new tax revenue the government brings in. Now, with the budget deficit continuing to get larger and larger over time as the gap between government spending and tax income grows, we're only going to see the rate of government borrowing increase. And as the situation continues to get worse, the government looks to be fully leaning into money printing and dollar devaluation, clearly seeing no other way to escape the situation that they have got themselves into. We've just seen a second successive rate cut decision, as the next big rate cut cycle is now fully underway, with additional rate cuts expected in 2026 as well. And Jerome Powell has already stated that labour market conditions are deteriorating and that the Fed tightening program could end soon, transitioning back into quantitative easing. We've now even just seen Donald Trump announce that stimulus checks are back, saying that the majority of Americans will now be sent a $2,000 tariff dividend, despite the Supreme Court still investigating tariffs and could potentially find them unlawful in the future. Now, this is expected to be in total $440 billion handed out to American consumers, which is a lot of money just to be pumped out there into the economy, and will ultimately cost the government a lot of money to pay it out, and also pour fuel on the fire of inflation that the Federal Reserve is trying to tackle. Now, going back to the topic of quantitative easing, it is a term that is also known as balance sheet expansion, but both are essentially just fancy terms for money printing. Now, money printing is something that is used to stimulate the economy, and in this case because of the very weak labour market, and we saw extreme money printing take place between 2020 and 2022 during the peak pandemic years to stimulate the economy through the pandemic. But this process does also lead to many negative consequences, including currency devaluation and also rampant inflation. During this period of aggressive money printing, we saw the US M2 money supply skyrocket from about $15.3 trillion at the start of 2020 to a peak of almost $22 trillion in mid-2022, which did have severe consequences on inflation as CPI surged to 9.1%. We have already seen the M2 money supply rise by about $1.5 trillion since the end of 2023, And while inflation hasn't yet risen to out of control levels, it has been rising steadily in recent months and has persistently been in and around the 3% level for a couple of years now, still way above the Fed's 2% inflation target. Now that rates are getting cut and the money printer is getting fired back up again, this is only going to cause prices of goods and services to rise and means that we could very much be in a situation that is very similar to the 1970s, where a second, even larger wave of inflation took place as a consequence of the Federal Reserve cutting rates prematurely before inflation was truly under control. And it's now becoming clear that it's not just individuals and institutional investors that are seeing the writing on the wall on what is coming next, but also global central banks who are running for the exit on holding the US dollar and US treasuries, and instead being pushed towards gold. The price of gold continues to surge, reaching astronomical heights of above $4,100 recently, marking a 56% increase so far in 2025, as investors continue to pile into gold ETFs at a record-breaking pace. Central banks have also been on a huge buying spree over the last few years, including 2025 as well, with buying activity hitting the highest level so far in the month of September. We can see that central bank gold holdings as a percentage of total foreign reserves has actually now overtaken holdings of US treasuries, which is a result of not just gold demand, but also a number of central banks losing confidence in the fiscal and monetary situation in the US and reducing their exposure to US treasuries. And two of the largest foreign holders of US treasuries, China and Japan, have both been reducing their holdings of US treasuries, with China in particular aggressively selling out of their holdings in recent years. The difference between the appetite for US debt and gold is clear when we see this chart showing the divergence between gold prices and real interest rates inverted, two metrics that have historically correlated very closely. The picture is very clear, and that is that trust in the US system is broken, and gold is seen by many as an escape to safety when the money printer is on and will be heating up in the coming years. When the money supply increases, we know that the price of gold increases too. And Chinese demand for gold in particular is becoming harder and harder to ignore, with Chinese gold stock levels surging vertically and demand amongst household investors also rising drastically, with Chinese gold ETFs seeing record inflows. Now, gold is more desirable in China because of its safe haven status, which is becoming more important with the continued uncertainty around China's trade relationship with the US. And Goldman Sachs are projecting gold to reach $4,900 an ounce by December of 2026, with increased business uncertainty in the US and both economic volatility and geopolitical risk also rising, all being reasons why investors in America are also flocking to gold. And also analysts like Ed Yardeni are also predicting the price of gold to go even higher, putting a price forecast on gold of $5,000 by 2026 and $10,000 by 2028 if current trends persist. Ultimately, investors know that they can print as many new dollars as they like, but they can't print gold, and the increased levels of inflation and dollar devaluation that we are set to see is only going to cause the price of gold in fiat currency terms to rise. Now, in a similar way that the government debt situation is looking like a bubble ready to pop soon, the stock market also remains extremely overvalued by traditional metrics. And new data around circular deal financing and fake revenue, fueling the AI sector in particular, could bring us to the brink of a once-in-a-generation market crash. Now, my previous video goes into more detail on this topic, which you can check out by clicking on screen right now. Aside from that, if you enjoyed this video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.